economy is clearly weakening. I'm astounded that Jay Powell continues to refer to the U.S. economy as being solid and strong. But then again, I guess he has to always sound like an economic cheerleader because he is a quasi-politician. The Fed, after all, reports into Congress. For people to think that there's a complete central bank independence, that's actually a bit of a joke. At some point, they'll cut rates enough, they'll steepen the curve enough, we'll get to the other side of the mountain. I said before, the business cycle has not been repealed. Recessions come to an end, expansions come to an end. It's just the cycle. Thankfully, expansions tend to be long. Recessions tend to be, 3 or 4 quarters. It's not going to last our lifetime. But there's nothing I think that the Fed can do right now to stop it because of all the lags that are still kicking in from what they've done over the past couple of years. People don't even realize that even by staying on the sidelines, over the past 12 months, as inflation fell, and you look at what that did to real interest rates, even though the Fed, in quotes, was on the sidelines, it was actually a backdoor 50 basis point tightening in real interest rates. And I believe that in a credit-driven economy, interest rates always matter, but the economy also always resets to shifting interest rates in both directions with long lags. There is no get-out-of-jail-free card for the economy coming off the most acute policy tightening cycle since the Volcker years in the early 1980s. So staring us in the face is that reset. And just remember that the Fed stopped tightening in the spring of 2006. And then nothing happened in 2007. That was a soft landing. The soft landing is a bridge, really, the transition from the expansion phase of the cycle to the contraction phase. And next thing you know, the recession starts December 2007, which caught a lot of people by surprise. So I think that's really what we're looking at. I'm probably the only economist that has not thrown in the towel on the recession call, because I don't believe that delayed is the same as derailed. And I can understand that those of us that have been calling for recession, of course, it's been frustrating because it hasn't happened yet. But I had the same feeling when I was calling for recession in 2006. I've seen this play out before. In any event, they're ridiculously behind the curve. I know it's not evident. They were behind the curve, and nobody talked much about inflation. Next thing you know, we have 9% inflation in the summer of 2022. They allowed themselves to get well behind the inflation curve. And now they allowed themselves to get well behind the economic curve. So by staying too loose for too long, we got the inflation. And by staying too tight for too long, we're going to get the recession. I think it's actually now becoming a reality. I'm seeing it in the data. You're seeing what's happened to pricing power. It is deteriorating. And I know people will say, well, it's not showing up in the jobs numbers, but it's only not showing up in non-farm payrolls. It is definitely showing up in the household survey. There's no doubt about that. And as far as the comment on the stock market, what's interesting is that anything that's touching AI, NVIDIA and the like, Microsoft, Apple, we ran these correlations and found that the Mag 7 space has a 0% correlation with the economy. But the rest of the market has a 50% correlation with the economy. And that might be one reason why the average stock hasn't risen for the past 19 months. But I don't know if a recession is going to undercut the Mag 7 because these are the longest duration stocks and people are buying them on an assumption of what the total available market is going to be for AI 5 to 10 years from now. So these stocks, not that I mean, these are great companies and they have great business models, but they're not great stocks as far as I'm concerned. Even people say, well, it's not as big a bubble as it was during the late 90s and 2000, but it's still a price bubble. Otherwise, they'd be good stocks if they were more reasonably valued. But I don't believe a recession is going to bring that part of the market down. Remember, when we had the similar situation back in 99, 2000, the NASDAQ peaked in March of 2000. And that was a year before the recession. The Fed had already completed its tightening cycle. NASDAQ went down 12 months, rolled over 12 months before the recession. And this because of earnings disappointments, order cancellations. Obviously, there were problems with vendor financing back then. But that was very idiosyncratic developments related to the tech space at that time that had nothing to do with the economy. The economy came later, especially when you consider why are people buying these stocks. People aren't buying these stocks because of the business cycle. They're buying them because of their bloated estimate of what AI is going to look like and all the spin-off effects. And that transcends the business cycle. It's, basically I think this part of the market, if you're looking at this, say fundamentally, they're being repriced for a whole new world of accelerating productivity growth because of generative AI and the rapid expansion in the GPU space and so on and so forth. The big problem, I think, and this is why I'm not a big fan of the value trade. All of a sudden people are talking about rotating into value. Value are basically cyclical stocks. I mean, really, are you going to buy the airlines in a recession? No. Are you going to buy the home builders in a recession? Probably not. Will you buy the banks in a recession? Probably not. These are very cyclical and they're shorter duration. The value trade works best when three things are happening. Inflation's going up, which means pricing power. Interest rates are going up, and interest rates and inflation are going up because the economy is accelerating. That is when you want to go long the value trade. I have an assumption that the economy is weakening, that inflation has come down and will continue to come down, and that the economy is most likely recession bound. You don't normally want to own value stocks in that sort of environment. And if something happens in the AI space, there is an earnings disappointment. Do you remember it was not an economic number that brought Cisco down, which ultimately brought the whole sector down back in 2000. It was Cisco missing its EPS numbers by a penny. That's all it took. And I've been saying all along to American investors, take your profits in the US and move the money to other stock markets around the world. There are some that still have particularly solid characteristics. So I don't think that's really a bear market narrative, but it's really just being rational and being disciplined and being prudent. So diversification doesn't just mean across your equity portfolio or your asset mix. You should also have geographic allocation in your portfolio as well. Like right now, we put out more of a bullish piece on the UK market, for example, one of the few areas of the world where there is now political stability, both in absolute and relative terms, and a market that isn't screaming for rate cuts because they don't really need it. And so we also like sterling because the Bank of England may well be the last central bank to start cutting interest rates. So, I span all investments and I span the globe. But of course, everybody believes that there's only one market out there, and it's the S&P 500. By the way, the average stock in the United States is the same level today it was back on January the 4th of 2022. So that's basically 19 months of nothing for the average stock. So it's not even the S&P 500 anymore, but it's a very concentrated index. And I have my concerns. And the higher it goes, I think ultimately the harder it's going to fall. But that day hasn't happened yet. And the only stock that I've gone back decades and decades that never seems to lose your money in a recession, and there's one stock, Walmart.